Silicon Valley Bank's collapse, it set off obviously a chain of events impacting tech and the banking industry overall. We saw a huge, massive ripple effect on startups in particular, and we're still trying to make sense of what exactly happened today. However, the bank run also created a lot of opportunities out there for fintech disruptors and challengers, some of whom were already on standby to shake up the banking space. So we want to have a look at how some of these challenges were addressed and the new financing opportunities that have emerged as a result. Joining us next is Immad Akhund, CEO of Mercury, a company engaged by more than 100,000 startups. When the SVB folded, Mercury swooped in with over $2 billion in deposits. So please also welcome Erica Brescia, general partner at Redpoint Ventures. Erica has been a leader in the open source community for more than 15 years. And it's worth noting here that both Immad and Erica are also active angel investors and founders who understand the unique needs and the quirks of startups. So let's dive into what's next in fintech from Erica's and Immad's perspective in an interview with Brainstorm Tech co-chair and my friend, Terry Burns.
Immad, Erica, we're very excited to have you both today. Thanks for coming.
Thanks for having us.
Great to be here.
So let's go ahead and jump straight in. I'll start with you, Immad. An estimate recently came out that roughly 20% of all account transfers from SVB went to Mercury, more than any other neobank, and second only to JP Morgan Chase. I would love to hear more from you about what role did Mercury play in really helping tech companies recover from a really scary and chaotic moment?
Yeah, so Mercury is a neobank. We target startups. Really, our bread and butter is early stage tech companies. We were already, I would say, for that segment, neck and neck with SVB. And obviously, when this collapse started happening, I guess it kicked off on Wednesday in March. We were, really made ourselves available to get as many people to sign up to Mercury and help them kind of get set up very quickly. And as a tech startup, obviously, we can react really quickly to these changes in a way that a normal big bank can't react. I was a SVB user in my previous company, so I was sad to see what happened to them. But I do think, whether it's the big banks or regional banks, banking is kind of weird. It's one of the few things where it's basically all bits now, but it's still dominated by 100-year-old companies. So I think this wave of kind of fintech is, I would say, still just beginning.
Erica, you were quoted in Fortune last month speaking about the SVB fallout, and you said, quote, "The current panic is fueled by the subset of VCs that are trying to race their way out of SVB." So do you think that VCs are to blame for the bank run?
No, I don't think VCs were to blame for the bank run, but I do think what was really unique about SVB is there was this concentrated set of customers and relationships and a really strong network that just you don't see in most other banks because of the concentrated customer base that they had. And there certainly were a subset of VCs that really rushed to tell their companies to pull out all their capital as quickly as possible. And there was another set of VCs, ourselves included, but many, many others, who were trying to keep everybody calm and rational and give sound advice, which was, hey, first of all, you should have multiple banking relationships. If all your funds are with SVB, you need to open up another bank account, move at least 6 months of your operating capital out of SVB, and make sure everything that is over 250K is kept in, whether it's sweep accounts or other secured facilities, so you're not at any risk. But we really tried to take a thoughtful and measured approach, and it was interesting to see from the inside just the energy and near hysteria and how quickly things were changing on the VC side, and folks were jumping to tell people to pull their capital out. And at least for me, it felt like there might have been an opportunity to kind of slow and stem some of the tide if we'd been able to work a little bit more in concert and take a balanced and rational approach.
I mean, the SVB thing happened from 8 a.m. to 2 p.m.
Yeah.
That was 50 billion in that time period.
Yeah.
But Signature, First Republic, I mean, that was like a multi-week thing, and they're not as influenced by VCs. So
Yeah.
I think there's this interesting dynamic where, if you're a public bank, like your public stock gets hit because there's an earnings release or something, and then your depositors now panic on social media. Like that dynamic is very new. It hasn't existed before. So at least when it comes to regional banks, this is kind of like not just a tech problem. This is a general problem. And I don't know what's going to fix that because, the big banks have this like implicit government guarantee. Regional banks don't have, most of them only have 250K in FDIC insurance. And it's not obvious as a depositor why you should trust like this regional bank when you have money there. Like, why should you leave it there, right?
Sure.
So it's a weird like game theory that played out with these three banks, but I don't think that's I don't think it's finished.
To the point about trust, I think this is a point that I definitely want to double down on a little bit, especially as a neobank, a relatively new startup institution. How have you instilled trust in, especially many of your new customers who I think, are rightfully so, really nervous perhaps about their banking systems right now?
Yeah, I don't think it's reasonable to ask our customers, or really for any bank to ask their depositors to just trust them. So the way we reacted is we actually increased our FDIC insurance. So we basically sweep all of the funds that anyone has with us. We increased it from 1 million pre-SVB crisis to 5 million now. And then we also give access to anyone with more than that, well, really anyone on Mercury, access to treasury accounts so you can put money in US government T-bills via Vanguard. So, my thinking and what I say to customers is, hey, this is what we say, and you should trust that. But at the same time, you have the assurance of 5 million in FDIC insurance, and the rest, anyone doing sensible cash management wouldn't put the rest of it in a bank account anyway. They would put it in treasuries. So that's what I tell customers, and that gives them a lot of confidence in Mercury. But it's hard for a regional bank to do that because we can't lend against these deposits. We already sweep them anyway. A regional bank has to, the banking model is you take on deposits and you lend against them. So
they have to be a bank.
Yeah, they have to be a bank. So
Yeah.
Tech companies can be more creative about these things.
You also did a pretty good job with transparency even way before the crash, though, I think, in helping people understand exactly how you work and where the risks may or may not be in working with Mercury, and I think that served you really well.
Yeah, I mean, trust has always been the hardest thing
Yeah.
for Mercury, right? When we launched in 2019, and I remember having a conversation with someone, and they were like, I have raised $5 million. It's the most money I've ever seen in my life. Why would I put it in Mercury? And I was like, fair point.
Yeah, absolutely.
Now I can make a better argument, I think.
I'm going to ask one more question here, and then I'm going to open up questions to the audience, so please start getting your questions ready. I'm curious to know more about early warning signs, whether or not either of you thinks that there were any early warning signs that a crisis was on the horizon. And if not, what are things that you both in your relative positions want to look out for in the future to keep in mind for potential crises?
There were some blog posts and things starting back in December, so there were some warning signs, but I think a lot of people dismissed it as SVB had they had $200 billion in deposits. This was not, it seemed like otherwise a healthy bank. And then, I think when they went to they had to make a filing, right, about the $2 billion that they went to raise. And that's when everybody had this whoa moment of, hey, what's happening? And I think, social media really just set the flywheel in motion, right? And, to Immad's point, within a day, $40 billion evaporated out of SVB because people saw that filing. I do think, SVB failed because they made poor decisions around, interest rates and taking a healthy investment approach to deal with this influx of deposits that they had. So perhaps the bank would have failed anyway, but it certainly wouldn't have been in as spectacular as a fashion if we didn't have the social media kind of fervor around what was happening. I think there's a lot to be learned from that for the future. I think the Fed learned a lot. I don't think we've ever seen a bank run like that before. And when you look at the dynamics, it kind of makes sense, right? You have this highly networked and concentrated base of customers in SVB, and a lot of folks that were very active on social media that just made things happen faster than anyone expected. And I think there's a lot of learnings to take from that in terms of not only how startups responsibly approach financial management and treasury management, and also, how these things may come to pass in the future and how quickly we need to respond. I think, when the Fed came out with their review of what happened, they admitted their own lack of oversight and action and slowness to react when they saw the initial warning signals.
Any questions from the audience? Right over there, just wait 1 second. Please state your name.
Hi, Joe Marchese with Human Ventures. I just had a question. Did you see any correlation between the 6 to 9 months before of crypto banks failing and then the run on SVB afterward, and or some of the investors who might have been invested in both?
I think the cause in a way is the same, which is in 2021, there was a lot of money swishing around, and people were not being responsible for where they place it and how they think about the risks around that. So, if you think about DeFi yields, like I was talking to people, I was saying like, if you're getting 10%, like you're taking risk. And they were like, no, it's like no risk. Didn't make any sense. And similarly, SVB put 100 billion in like 10-year mortgage-backed securities for 1.9%. Like that's not a lot of yield. But it was, I think all of it was a zero interest rate kind of phenomena. So that was like the underlying, like kind of, it just screwed up everyone's kind of risk management profile, let's say. Hopefully we learn these lessons, but I would say every like 20 to 40 years, like people forget all of this and we have a new bubble and we have these mistakes again. So at least we're immune for the next 5 to 10 maybe.
Immune sounds like a risky thing to say, but I hope you're right. I do think a lot of lessons have been learned. And like one of the things that we saw too was because of the level of investment happening in 2021 and the sizes of rounds going into very early stage companies, sometimes you had companies with 10 or 15 employees that were taking on $20 million worth of financing that didn't have finance teams that were sophisticated and knew about treasury management. And boards would of course make certain inquiries and approve investment policies and things like that, but that takes time to all happen once an investment happens. And I think this was a really important wake-up call, I think, for startup founders and quite frankly for VCs who might not have had as close of an eye on this shortly following investments, to make sure that people are following sound financial management practices. And then, on the regulation side, I think we've learned a lot from this, and now, hopefully we'll see some very healthy levels of regulation and oversight come out of it to prevent these in the future. I hope that leads to immunity, but maybe I'm a little
Only time will tell.
Skeptic, yeah.
Any other questions from the audience? We have a question over there. Hey.
Hi, Emily Sherberth with APCO Worldwide. Erica, you mentioned that filing was sort of the trigger for everything to kind of domino effect from there. Do you think a good crisis communications plan that maybe this SVP, like comms team could have put in place, or some sort of comms plan could have saved the downward spiral?
I've thought a lot about that because I was on the call that many know happened with Greg Becker, and I was actually on a call with him a week before with another group of VCs following an article that had come out in the Financial Times. And, this was not a demonstration of a spectacular comms strategy, right? I mean, I think everybody can agree that the comms could have and should have been much better. I mean, getting on the call and telling everybody not to panic was probably the worst possible thing that they could have done. I don't know, honestly, if a great comm strategy really would have stemmed the tide, though. Just given how quickly everything was happening and the amount of energy already out there in social media, it would have been hard to quell. But yeah, certainly I hope every comms person has looked at this and learned some lessons about perhaps how to approach things better in the future. I do think the gentleman, I can't remember his name, who came in, did a spectacular job after the Fed took over SVB in communicating what was happening and really instilling a lot of confidence and calm. I only wish he could have come in prior to the crash of the bank and maybe prevented it in the first place.
I want to zoom out just a little bit here and think about some of the US economic conditions that are at play right now, whether those are recessionary measures, debt ceiling, inflation, et cetera. How are US economic conditions impacting both funding and growth for early to mid-stage startups? Whether that's, in your case, Immad, from Mercury's standpoint, or I know that both of you are active angels as well. What are you seeing in the market with your own portfolio companies, the impact of the broader market on funding for early to mid-stage startups?
I think it's kind of interesting that the US has not really gone into a recession. It's actually fairly resilient. I would say the VC economy has been in a recession since November 2021, so a year and a half ago. You can see every quarter there's less and less funding. Actually, yeah. Q2 is not out, but there was some numbers are out, but it's almost certainly way worse than Q1, which was already way worse than every quarter last year. So I think we're in the fundamental reason is things that make sense to invest in when interest rates are 0 don't necessarily make sense when interest rates are 5%. So
sure.
There's a big pullback. I think that will continue actually for the next year or so. I think it's going to be pretty depressing times in the startup ecosystem. Lots of companies will fail and things like that. But I think there is something healthy about it. We were in a pretty deep bubble, and I think a lot of people burn too much money, raise too much money, and all of that kind of stuff. I don't know what happens in the US economy, but weirdly, I think the VC startup economy is on a different cycle. And even, you saw it in 2009. The US went into a pretty deep recession, but VC funding only slowed down for about 9 months. So I think actually it won't be on the same cycle.
Yeah, I think there is some nuance to that, though. So seed round sizes are actually going up, which is interesting, but the number of deals getting done is going down. So what we're seeing is hopefully higher quality companies getting funded. And what's interesting is, in particular with AI, we're seeing so much energy and excitement that a lot of folks that had maybe previously exited a company, that were in executive roles are actually now taking the leap to start a startup again because they just can't resist the market opportunity. And so we're seeing a lot of interesting things get built. And certainly in AI, we're seeing, I'm sure you've all seen in the press, some very, very large rounds getting done very early and at very high valuations. And it's almost like a bifurcated market, right? If you're building a core AI company versus anything else, we're typically seeing dramatically different valuations. To Immad's point, at the growth stage, I do think we've seen virtually every company has lowered forecasts, right? So we are seeing growth slow down from a company perspective. And the Series B market and C market has been very slow for quite some time, and I think that will continue. What's really interesting, though, is the valuations haven't come down that much for the deals that are getting done. There's a real flight to quality that's kind of, funny enough, driving the prices of the rounds of companies that are actually executing well and showing really fantastic growth and momentum in this environment. They're still raising spectacular rounds. So, fewer rounds are getting done, but I think it's into companies that are building more financially healthy and sound businesses. So I think this is overall a great thing for the ecosystem, and the companies that do make it through this are going to be much healthier businesses moving forward.
Great. Immad, Erica, this was great. Thank you so much for your time.
Thank you.
Thank you. Bye.